Hello and welcome to the 2022 Enspire Talk Show. Today we're going to be talking about a popular topic in today's age, stocks. We will also be going over the importance of stocks and what people's perspective on stocks is.
For this topic, we are specifically talking about the American stock market, since it is the largest and this is also where we are all located. Like Adarsha said, stocks are very important for funding new ideas and just funding companies in general that may have been overlooked by private investors. However, stocks can also be dangerous, such as the crash in 1929 and the crash in 2008. Both of these caused a lot of hardship for a lot of common day Americans and were directly affected or were directly caused by the stock market. Speaking of crashes, could of these crashes been prevented if there was government regulation in the market?
These crashes could have easily been prevented if there was government regulation. But the main thing is that people have to be educated on how the stock market works. For example, and if a company is going bad or if the company is not doing well and if the stock price is plummeting, then everybody will keep on selling their stocks until the company is almost no more. It's at the very bottom of its life. But the thing is that if people are more educated and if companies are more educated, then these crashes won't happen that much.
I agree with Vidal's point because the more people are educated on stocks, the more smart investing happens. One main tip in order to smart invest is to have a savings account where you put all your money that you earn from stocks or any other asset that you get money from. So just in case, just like as Steven said, stocks can go either way. They can plummet your condition or they can make you rich. And just in case they make your condition worse, you always have a savings account to back you up in order to get back up.
Vedant and Jason made excellent points on investing stocks and all about smart investing. Another point I want to bring up is having patience when investing into stocks. Having patience when investing in stocks is a very important skill that a lot of stock investors and popular stock investors possess. So why would having patience be important when investing in stocks? Well, a lot of people after investing into stocks, things might go downhill and they might immediately sell it after a while. After thinking, okay, well, this is not working out. I think I should get the money while I can. While this could prove to be a smart move, a lot of the times this doesn't happen. So being patient when investing in stocks, especially into higher or lower companies, could benefit that specific investor.
I would have to also agree with Adarsha's point, and I would also like to bring up the point of another smart investing tip is to always have diversified portfolios. Now, what a diversified portfolio is instead of having all your money into banking, so having your companies in a portfolio like just Visa or JP Morgan or any other big bank. Instead of maybe not JP Morgan, however, but instead a company like Home Depot, which is a consumer goods program instead of a banking company. So what this does is if banking were to crash, like what happened in 2008, now you only have a couple stocks that are affected by that and not your entire portfolio. And also people may be looking to take money previously lost and salvage some of that and put it into other companies, which some of these other companies may be companies you've already invested in previously, which could even make up some of the losses you took from banking. And of course, what also happened in 2008 is that the crash recovered fairly quickly. So a diversified portfolio is a very smart idea for keeping money in your own hands and not losing it in mass quantity.
So how do you guys think that people can better educate themselves about the stock market and how it works?
Well, I know my school offers courses on learning about stocks and more about the economy, which I think is a very great thing to have, especially in school when kids my age, younger, older, can learn about stocks and they can use this information going into college and even when they're getting a job. Learning about stocks from a young age can make your life a whole lot easier in terms of managing your finances and even profiting from learning about stocks when you invest smartly. So I think having the ability to teach kids at a young age is a very important thing, and I think these courses about stocks should be incorporated into a majority of schools throughout the world.
Another way that students, especially young adults, can learn about the stock market is not just by having school courses or taking up school courses about stocks, but it's about listening to the news. the The news is pretty up to date on what it covers. So rarely any time will you be too late to the trends if you discover them. This can help this people invest in the stock market, because if people are if people are not updated on the news, then it might take a few days for people to actually find out the price of, for example, Samsung is falling down and plummeting. But if people are more educated on the news, then instead of waiting like 2 or 3 days to figure out what's happening and what you should do, maybe they can wait for just a few hours and maybe figure out what to do in just that small amount of time. So the news is a great way to spread information around about the stock market, and people should utilize these helpful resources whenever they can.
Following up on Vidon's point, to the investors who are looking for tips or ways to make it happen on how to earn money and all of them, obviously, I'm pretty sure everyone has at least heard once that stocks they can make you rich. But other ways you can educate other people around you and focus on smart investing is by having a stake in the company, because buying the stock off a company offers the investor only a portion of the ownership in the company. And you should grow wealth as underlying companies grow and make even more profit to their stockholders, which can be a source of income. And last but not least, you should trade a lot and watch the news, just as Vedant said. Stocks are marketable instruments, basically, with spectacular properties. A lot of people trade stocks for spectacular purposes. These traders are active in the market, buying or selling stocks, and in fact, stock trading is a popular profession like this. Whether you're buying, selling, or just learning, it's very important to keep your eye on what goes around in the stock market.
Another very important investing tip that I found is that not just having a diversified portfolio, not just watching the news constantly, is to have other people and to do it for you. Now, this may seem very counterintuitive. However, it is actually very smart because, like Jason said, there are people dedicated to their entire job buying and selling stocks. However, this isn't just for their personal interest, it's also for other people's personal interest. Now, this is what you call a stockbroker. However, there's actually a form of that makes a lot of money on a daily basis. Now, this is called a mutual fund. What a mutual fund does is it virtually allows you to have as much stock as invest as much money in as you want, and then they themselves choose what companies to invest it in. Of course, it's an even share of compared to everyone else's money that they're investing in. So what this means is that they're acting sort of like a middleman. They're taking your money and they're putting it in the companies that they think will prosper the most. Now, what is to stop these people from messing up? competition, very high competition. These people get paid millions of dollars a year. So this is a lot of money that they don't want to lose. And they are very strict with it too. In most cases, if you go down by at least 5%, or even sometimes less than 5%, if it's a good enough economy, these people get fired and a new person comes in. So what this allows for is it takes investors a constant time to think on their feet, or they could simply invest in the stock or invest in a mutual fund and have other people do it for them while they can continue their general life.
So
I wanted to ask you guys a question on we discussed on what the downside or the good parts of investing in stocks and the benefits of investing in stocks. Could we brush up on some of the downsides of investing in stocks and how these things can negatively impact someone's life, I guess?
so most of these downsides happen mainly because of human error, whether it's in the investor or whether it's people that are actually working in the company. So a way to prevent these crashes from happening is from people staying educated. In that, and that's what we already discussed previously. But one thing that people actually don't look at when they invest in companies is that they have the misconception of that they have to always invest in the big companies. But the problem is that most of these companies are so big that they can't even grow. They're mainly plateauing at over here. They're not growing, or they're not even declining their stock price. It's just that they're constantly staying there and they're not really doing anything. But if a person decides or investor decides to invest into a smaller company, which stock price is not as big as the bigger company, then the company has room to grow, which is what most people actually don't realize. Because yes, stocks is about money and making huge, vast amounts of money, but it's mainly about growth as well. Because how else are you going to make money if the company's stock price stays the same all the time?
I also agree with Vedant's point because more cons about stocks is that first of all, there's obviously a risk about you losing your money, and then second, there are stockholders of broke companies get paid last, and just as Vedant said about the small companies who go through the boom and bust cycle, who should boom at any point, they do get paid last, and that is sort of a backfire for being a rookie company in the stock market. And not only this, but there are taxes on profitable stock sales, and this can also backfire because let's say you bought a stock and you think it's gonna boom, but there are also taxes that you have to pay. And not only this, but there are people who take time for their whole lives to do stocks and trade for a living. But you have to remember, the stock market is attracting many, and many people are getting more educated than and they could learn more in 1 year than you have learned in 10 years, because competing with institutional and professional investors is really out of your game.
I'd have to agree with that, and I think that also brings up a great point about reputation of stocks. So, like Vedant and also Jason has mentioned, stocks that have established reputation may not do as well. And to be fair, that is true. However, stocks that do less, they also have a chance to do worse, and they do on average have a higher chance of going bankrupt. However, of course, some make a very, very large effort to go the extra mile, and such as Microsoft and Google, they made a lot of money, and they practically doubled, tripled, even over 10 times the amount of the original stock price from when they started out. So what this means for these companies is that they make a lot of money. However, over 90% of tech companies at the beginning of their early stages of the tech boom went bankrupt. So what this shows that there's obviously a lot higher risk. So what to do if you're a safe investor and don't want to lose a lot of money? Solution is pretty simple. It's known as a blue chip company. So this term has come from a blue chip in poker, which is, if you don't know, worth 100 points and the highest points. So obviously by that name, you can tell these companies are highly valued compared to their competitors and peers. So these companies are the big names you would see on the Dow, the biggest ones on the Nasdaq, biggest one, and of course, the majority of the S&P 500, all big stock exchanges. So what these companies are is that they do a very good job of keeping their rate high, and they never go down that much significantly in price unless if everyone else does due to a recession. They stay at their constant rate, and while they do go up slow, that's true, at the same time, they don't go up high and they don't break out. Now, the reason why is because when they do break out, that means that most people are likely to sell their original. People may be more tempted to sell, and that might cause for the stock to get off track a little bit, and this would cause for a lot of people to lose money in that specific stock. So, but these companies stay consistent after a very long area of time.
That was a great point that Stephen brought up on how more people should invest into multiple companies instead of taking the risk. And I think it's a concept that we all have been talking about when discussing about stocks, is how people should not put all of their money and all of their trust into one company, I should say. And you have the downside of that company completely destructing, just not going the way that you expected it. So taking a chance on multiple companies is expected, and you might not get the results or the profit that you may have hoped for, but it's a lot better than just completely losing all of the profit that you've earned up to that point. Which goes back to the general topic of just smart investing and how the best of the best investors have developed these concepts throughout their life and their career of investing into stocks.
So one common misconception that I've seen is that most people are very impatient while investing in stocks. So how do you guys think people can maybe make smarter decisions about which companies to choose from and how long to keep their stocks in the company for?
Vedant brings up a really good point on being patient in stocks. And this is something this is also another important aspect of smart investing. For example, let's say a person invested in Apple years ago, decades ago, when Apple was just a rookie company in the stock market. And now, with Apple being a large company as it is, doesn't really have the strength to grow as much anymore as it did before. So let's say someone invested in Apple, like let's say 10 decades ago or decades ago, and that person, let's say, only made $800 or $900, or let's say $5,000, and then Apple then started to plummet down. And after it plummeted down, the person is like, okay, I might get as much money as I can otherwise, or I'm going to lose all my money and get nothing back. So they just took the money instead. But in the stock market, especially nowadays, you never know what's going to happen. Stock markets can go from up here to down here, or they can go down here to up here. And you should probably keep their trust in them, because eventually, maybe one day, that company will boom up from being a small rookie company to making lots of money, and you get more than what you paid back.
So I wanted to share a very good example of someone who has invested in a company when it was starting. So some of you guys may know, like, the famous basketball player called Shaquille O'Neal, who played with the Lakers. So basically, his story is that one of the first companies that he's ever invested in, which was Google. Back then, when he invested in Google was such a small company, like almost nobody has heard of it, and that time was a super long time ago. But Shaq invested in it despite Google's being such a small company. I mean, the first few years, Google did not do that well. But after a couple of years, after the tech boom started happening, and then Google was one of the biggest companies in the world. It was, everybody was in awe about what Google was doing in the market. And guess who into Google first? It was Shaq. So he made tons of money off of Google. So the main takeaway here is that people have to be patient when they invest in stock companies, because not every company is going to do good in their first year.
Yeah, I'd have to agree with that point. And I think a big concept, especially for the newer investors, to have a chance investing in these startup companies is simply doing their research. A lot of companies in their future can be held in what ideas they're currently presenting. And while they may not be able to go to Wall Street every day and hear the salesman pitches, they could easily be able to go to the websites and see what current, for I guess an example, what Apple phone plans are planning out and what Google new software is planning out, or I should say Microsoft software is planning out, and really take a good look at it and see if this is a profitable idea. Now, if they were to do this, then they'd have a much higher chance of getting money off of it because they could predict beforehand of when this material actually releases.
Going back to Vedant's question on how, our answer, I should say, on how Shaq and his investments about Google, I want to bring up another point about a man named Ronald Wayne who invested about 10% in Apple at the time. And he sold it a couple of days later for $800. Now, owning 10% of Apple, that would have been worth over $95 billion today. And that obviously is a huge loss in money, and he's probably still mad to this day. But this overall gives us another example on why people should just genuinely be patient. And I think, to me, that's the most important concept about a lot of things, especially about investing into stocks. And I think more and more people today are understanding and learning about this concept in general to become better stock investors in general and improving the stock economy.
Stocks do not make money on their own. Rather, since stocks represent the ownership in the companies that issue them, their values are tied up to those companies and how much money those companies are making. However, stocks are traded and on the exchanges independent of the companies so that their prices can fluctuate widely and gradually.
So to sum it up, we talked about how to invest in stocks and what to look for when we invest in stocks. We also looked on some overlooked things and some overlooked techniques that people fail to recognize, and also some common misconceptions. We also found solutions to problems why people tend to stay away or refrain from investing in stocks. And we also talked about why stocks are generally great. So, despite all the drama surrounding stocks, if you really want to make a difference while still being a rookie in the investing market, you should turn to stocks to help hopefully fulfill your dreams.